Hello and welcome to CNBC TV18 with me, Parikshit Luthra. Today we look at the budget recommendations of the private equity venture capitalist sector. The industry has asked for a more enabling framework to boost private equity and venture capital investments into India. Some of the key demands are tax parity for investments in listed and unlisted enterprises and need to bring certainty on carried interest to avoid friction across regulators. According to an IVCA EY report, October 2022 recorded $3.3 billion in PE/VC investments, 75% lower than October 2021 and a 60% increase over September 2022. Joining me now to take this forward and discuss the budget recommendations and ways to boost PE and VC investments into India are Gopal Srinivasan, Chairman at TVS Capital Funds. We'll also be joined by Vivek Soni, private equity leader at EY India. Gopal Srinivasan, you've had key meetings with the finance ministry. If you were to give some of the key recommendations, which according to you are necessary to giving a boost to the PE/VC industry, what would those be?
Parikshit, thank you for having me on the show. Let me just state the principle which is guiding any recommendation that we make. And our principle is very, very simple. Out of the 6 lakh crore of money pooled into AIFs, about 60% is domestic and growing. But out of the total amount of PE investments, like what you referred to just now, 85% is overseas capital. The industry wants domestic capital to grow and wants to continue to welcome overseas capital. With that lens in mind is where all the recommendations have been made, number one. So when you look at it, what is the first issue? If short-term liquid investments in the public market are given a lower tax rate and long-term risk capital, which is illiquid, is given a higher tax rate, nearly 50% more, then the incentives to the family offices and many of the other Indian investors is to say, let me weight my decision basis the tax rate as well as also the expected return. We want this to be a pure market-driven decision and have the identical rate of long-term capital gains tax for both the listed market and the unlisted market. By the way, I do not believe any other large economy in the world has this difference. And this came in India for historical reasons. It should be now eliminated. The gap has been slowly closed. From 0%, the listed market has gone to 10%. We think it should all become, say, 20% for all, and life should move on, number one. A second recommendation on which we appealed to the Honorable Prime Minister and the Honorable FM last December is to recognize the alternate investment fund asset class as a very special kind of animal, providing more than 1 lakh plus crore of investments to the country each year and growing. We believe that the 10 trillion vision will actually be a 25 lakh crore asset class, as against 6 lakhs pooled now, and providing 1 lakh now, providing 5 lakhs a year then. For that point of view, some of the tax regulations need to specifically call out our alternate investment fund asset class by name and give it rules. Let me give you two simple examples. We are the only pooled asset class of any significant nature and equity where the expenses of management are not deducted from the income earned by the fund because of the pass-through nature, which is not very well defined in our opinion. Second, as an example, the profit model of a manager, we actually don't make any profit every year. Often we use our own balance sheets to fund our expenses. All our profit comes when all the exits have taken place and we get something called carried returns globally, additional returns in India. We believe that this clearly under law, we are told comes under capital gains. It is nowhere defined. So it is left to the whims and fancies of assessing officers, courts, tribunals to decide what it means. We believe only one body in India should make tax law. It's called CBDT. And CBDT should call out the carried interest explicitly, defining it as capital gains, using the reference to the fact that all income from sale of securities in a private equity or venture capital AIF fund are actually capital gains. This is our second set of recommendations. A final recommendation, again, we're very grateful to the Prime Minister, the Finance Minister, the DPIIT Minister for their encouragement. There has been a talk in the last budget of a blended fund of funds, which means the government through the DEA will create or sponsor the creation of fund of funds where money will come from PFRDA regulated entities, IRDA regulated entities, public sector banks. And a lot of third-party money will come, creating a very high leverage on that. For example, the SIDBI fund of funds, for 1 rupee given by SIDBI from the government, nearly 5 rupees has come from third-party sources. So that's what makes it a blended fund of funds. So we believe that also should start, and that should pretty much start soon, especially for areas like agri, space, defense, rural. These can be very, very game-changing, just the way SIDBI was. SIDBI fund of funds created a revolution. So in summary, 3 simple, modest ideas which we think are doable. And this morning, I don't know whether you saw, Parikshit, the encouraging message from the outgoing Revenue Secretary, Shri Tarun Bajaj, who has spoken on this many times, saying it's high time we fix a long-term capital gain structure, made it simple, made it market-friendly. When he has said that, all we can say is from your mouth to God's ears. Thank you, Parikshit. These are my points.
All right. So, all right. All right, we'll come back to you again, but let's see what the budget has in store when it comes to tax parity. Let me get in Vivek Soni at this point. Vivek, EY and IVCA have been tracking the flow of investments into India for the last 6 to 7 months. There has been a declining trend, barring October. What do you think is the trajectory? And if we look at the budget now for next year, what can be done to give the investment ecosystem a boost?
So firstly, Parikshit, thank you for having me on board this show. It's a privilege. I hope I'm audible very clearly. With regard to your question on the declining trend and then a sequential rise in October, see, these monthly fluctuations will happen. What we have seen all over the world has been a massive increase in business uncertainty. The entire business environment has become very volatile. It becomes very difficult to call on certain basic things like prices of commodities. Interest rates have gone higher, faster than what people thought, catching a lot of investors on the back foot. In these times, it's logical for people who have a fiduciary responsibility to their LPs to deploy capital to go a bit slow, to see if there are any more uncertainties that are going to be rolled out, and then you price them in, right? And this is what's happened globally. And India is not island of its own. We are connected with the overall global economy. And that is also what we have seen happen in India. Our personal view is in 3-4 months, when there is a bit more clarity, things will get rolling again because the Indian economy is on a solid foundation, right? And we are continuing to grow, which is very different from what we are seeing in other parts of the world.
Right. But any kind of regulations that can be done away with in order to make it easier to do business?
See, at the outside, I wanted to say, look, the government's done a fantastic job so far, right? You've seen how the PE/VC ecosystem has evolved. In last year, 2021, we had $77 billion of investments and almost $45 billion of exits. That's a $120 billion ecosystem. We think the Indian market will cross the $100 billion threshold of PE/VC investments in the next couple of years. A lot of what the government has done has made business easier. And as Gopal highlighted, there are 3-4 more avenues which the government could look into. A, to increase the flow of domestic capital into the alternate asset class. It has been lacking. Our pension fund industry is just about discovering equity. We need to get them to discover private equity as well. What is happening really is foreign savings are coming in India to bridge the gap between our investment requirements and our domestic savings. And if pension funds of Canada and of US are deploying large amounts of capital in India, why should the Indian pension fund industry be held back? Let them evaluate. Let's reduce some of those tariffs. So that is one part. The other part is not just investing into India should be easy, but even exits and taking capital out should also be easy. Now that is aligned to taxation. It is aligned to predictability and clarity on capital gain structures. These are some of the things. The other thing which maybe the government could think of is look into the framework for domiciling of foreign companies into India. There could be very well Indian companies that have gone overseas, but now are reevaluating coming back into India. Or for that matter, if the strength of the Indian economy continues to grow as an outlier to the rest of the developed world, maybe other foreign companies could also think about coming into India. Right now, there is no framework for domiciling them in India.
Right.
Why don't we think about it? It'll just increase the investment flows.
Okay. All right. Mr. Srinivasan, coming to you, when it comes to budget asks for the startup industry, now this has been a key priority for the Narendra Modi government. What can the budget do in order to give it a further boost? We have seen large-scale cost efficiency, cost-cutting measures, layoffs across startups. What can be done to give the startup ecosystem a boost, a further boost?
Parikshit, I would just want to add to what Vivek said first. Large overseas domiciled large startups are moving back to India because they're saying, wow, what a great place to list. See what happened to the Indian companies that went overseas and listed, right? Fantastic news. Great proof of India as a fabulous destination. But as equally said, smaller startups, foreign VCs are forcing them as a condition of their money to domicile abroad. How can we rationally deal with this rather than make it a foreign VC behavior issue? I think the way to do it is to find out why they're doing it. My sense is that it is the ESOP regulation for startups that is forcing early stage startups when ESOPs become very important. A simple example, Parikshit. If there is a unicorn, it's worth $1 billion. Employee ESOPs are worth 50 million, which is 5%, right? 50 million, $100 million. Now, if I'm going to say, you have to go to a inter-ministerial committee, they will decide whether for 4 years, ESOP, even if vested and exercised, will not be taxed. Then suddenly you'll see 25 billion valuation becoming 5 billion. They've already paid tax at 25 billion. Consider these aspects of this industry and allow 10 years to 15 years tax holiday unless the ESOP is either gifted, sold, or company going public. Even if the employee is fired, if he has a ESOP, we should be able to take it with him. I think that is the single largest pain point. Or kuch pain point bhi honge, but this will be the number one pain point. That is something where the early stage startups will not go abroad. That's what I would say as far as startup is concerned. But going to Vivek's point, one point I would like to add here is that fundamentally this issue of SEBI regulation, which has been changed very, very positively when the current chairperson was a WTM, that trend should continue. We should make sure that fund structures like perpetual capital vehicle, where institutions in India, QIBs, want to put money for the long term, are allowed to operate freely rather than be hand-tied because of these smaller investors. So institutional capital and AIFs needs to be greatly encouraged. The association has submitted to Mr. Damodaran and his committee that perpetual capital vehicles and QIB-only funds called large value funds should be greatly encouraged. We hope those investments would also take place. That will increase the domestic flow. So two separate issues I talk about. One is how to keep early stage startups in India by making sure that nobody makes them go abroad, even though the larger ones are returning, giving validation to India as a destination. And the second one is SEBI-related changes. Out of the 160 changes that the IVCA has submitted to the Damodaran committee, about only 20 or 30 are due to SEBI, and most of them are due to these frictions around fund formation, long-term nature of funds, and co-investments, for example, are not allowed. Co-investment is a global practice. SEBI has banned co-investment or made it a little cumbersome. Though it has permitted it by a PMS, it could be allowed more smoothly through co-investment units through the fund. So these are some of the issues around SEBI, around startup ESOPs that could probably, I would call out as accelerating more domestic capital and accelerating the stay in India drive rather than the domicile abroad and come back later after the shadi and after the children are born, you're coming back home for the listing. Stay in India even after you get married.
Okay, we've run out of time, but Mr. Srinivasan, Vivek, Soni, thank you very much for joining us here on Newscentre, giving us your view on what is needed to boost the PE/VC ecosystem in India and also give a boost to startups as well. We're going to take a break, but when we return, we will focus on China. Yes, in a rare occurrence, citizens are protesting in China against a zero-COVID strategy, asking Xi Jinping to step down. A special discussion with James Miles of The Economist and Anand Krishnan of The Hindu reporting